Imagine you own a championship sports team that's been consistently winning for years. Every season, you evaluate your roster, keeping the star players, cutting underperformers, and bringing in fresh talent. That's exactly what just happened with one of the market's most beloved dividend ETFs, SCHD. The 2025 reconstitution has arrived, and the changes are more dramatic than we've seen in years. The team's lineup has been significantly reshuffled, with energy stocks taking center stage, while financial players are heading to the bench. This isn't just another routine adjustment. It's a transformation that could significantly impact your investment returns in the coming year. ConocoPhillips has emerged as the new team captain, while longtime financial sector veterans like BlackRock and US Bancorp have been cut from the roster entirely. With the energy sector now commanding 21% of this ETF and financials dropping to just 8%, we're witnessing a seismic shift that perfectly aligns with the changing economic landscape. But here's what everyone's wondering. Is this algorithmic reshuffle a golden opportunity for dividend investors, or does it signal potential trouble ahead? Today, we're diving deep into SCHD's 2025 transformation to uncover what these changes mean for your portfolio, your dividends, and your financial future. The answer might surprise you, and it's definitely not what most financial channels are telling you. If you're serious about achieving financial freedom with dividends, make sure you smash that like button and subscribe for more game-changing income investing insights. The SCHD Foundation. Let's take a step back and understand what makes SCHD so special in the first place. Unlike actively managed funds where human emotions and biases can cloud judgment, SCHD follows a strict formula for success, a financial natural selection process that adapts to changing market conditions. Think of it as nature's way of evolving a portfolio. SCHD tracks the Dow Jones 100 index with a ruthlessly efficient screening process. To even be considered, companies must demonstrate at least 10 consecutive years of dividend growth, proving they can weather economic storms while continuing to reward shareholders. These aren't small players either. Each company needs a minimum market cap of $500 million, an average daily trading volume of 2 million shares, ensuring stability and liquidity for investors. But the selection process doesn't stop there. Picture a tournament where stocks compete for a spot on the team. Once companies pass the initial qualifications, they're ranked based on 4 critical metrics: free cash flow to debt ratio, return on equity, dividend yield, and 5-year dividend growth rate. Only the top 100 performers make the cut. What's fascinating about this process is its complete objectivity. There's no portfolio manager making emotional decisions based on market sentiment or personal hunches. The algorithm doesn't care about presidential elections, doesn't get nervous during market corrections, and doesn't chase the latest trends. It simply follows the data, rebalancing quarterly to ensure no single stock exceeds 4% of the portfolio and no sector commands more than 25%. This methodical approach has created something remarkable, an ETF that, until the recent tech explosion, actually outperformed the S&P 500 over extended periods. From 2013 through 2022, SCHD delivered a total return of 262% compared to the S&P 500's 223%, all while providing a steady stream of growing dividends. It's this combination of growth and income that has made SCHD a cornerstone holding for dividend investors. But now, this finely tuned machine has undergone its annual evolution, and the changes we're seeing tell a fascinating story about where the market and your money might be headed next. The Great Roster Change. Today, we're witnessing what could be called the Great Roster Change for SCHD. Just like a championship team that must evolve to stay competitive, SCHD has made some major moves in its 2025 reconstitution. Let's analyze who got drafted and who got cut. First, let's look at who's leaving the team. In total, 17 stocks have been shown the door. Pfizer, BlackRock, US Bancorp, M&T Bank, Huntington Bank, Tapestry, KeyCorp, C.H. Robinson, Dick's Sporting Goods, Zions Bancorp, H&R Block, Synovus Financial, Bank of Hawaii, Leggett & Platt, Cracker Barrel, Heritage Financial, And guess. The financial sector clearly took the biggest hit, with multiple banks and financial institutions getting cut. It's almost as if the algorithm sensed the challenges facing regional banks and decided to reduce exposure before the next financial storm hits. BlackRock's departure is particularly noteworthy. As the world's largest asset manager, BlackRock has been a wealth-building machine for investors. But the algorithm doesn't play favorites. Even giants can fall if they don't meet the strict criteria. Similarly, Dick's Sporting Goods is leaving despite delivering nearly 1,000% returns over the past 5 years. A reminder that past performance isn't always an indicator of future success in SCHD's selection process. But as these stars exit, new talent arrives. SCHD has welcomed 20 new additions to the roster. Yes, 20, not 17, because 3 companies in the previous lineup were acquired, leaving vacancies that needed filling. The newcomers are ConocoPhillips, Merck & Company, Schlumberger, Target Corporation, General Mills, Archer Daniels Midland, Halliburton, Ovintiv, American Financial Group, Autoliv, FMC Corp, Moelis, Flowers Food, Murphy Oil, Federated Hermes, Signet Jewelers, Interparfums, CNA Financial, Ennis, and First Financial. Energy stocks are the clear winners in this year's draft. ConocoPhillips enters as the new team captain with a hefty 4.6% weighting, immediately becoming SCHD's largest holding. Other energy players like Schlumberger with a 2.3% weighting, Halliburton, Ovintiv, and Murphy Oil strengthen the energy presence. This energy influx isn't a coincidence. It reflects stronger fundamentals, improved cash flow, and growing dividends within the sector. We're also seeing some comeback veterans return to SCHD after being out for a year or more. Merck, the pharmaceutical giant, returns with a significant 4.1% weighting. Target Corporation rejoins at 1.9%, bringing its retail expertise back to the portfolio. And General Mills makes its comeback at 1.3%, adding consumer staple strength to the mix. Some of the new additions might raise eyebrows. Signet Jewelers, Flowers Food, Interparfums. These smaller additions, each with less than 0.5% weighting, might seem insignificant individually, but together they represent SCHD's commitment to finding value wherever it exists in the market. What's most fascinating about these changes is that they weren't made because some fund manager had a hunch about energy or concerns about financials. These moves were dictated purely by the numbers: free cash flow, return on equity, dividend yield, and dividend growth. The algorithm has spoken, and it's pointing decisively toward energy while stepping back from financials. This dramatic shift in the roster isn't just about which stocks are in or out. It represents a fundamental reallocation of sectors that could have profound implications for your investment returns in the coming year. And that's exactly what we need to examine next. Sector shift, the energy revolution. What we're witnessing with SCHD isn't just a few stocks swapping places, it's nothing short of an energy revolution within the portfolio. Before this reconstitution, the sector breakdown placed healthcare at the top with 18.3%, followed closely by financials at 17%. Energy was quietly sitting in 5th place at just 12%. But now, energy has rocketed to the top position, commanding 21% of the entire portfolio, nearly doubling its previous allocation. This dramatic shift tells a fascinating story about the current state of the market. While most headlines focus on AI and tech companies hitting new highs, SCHD's algorithm is detecting extraordinary value in the energy sector. It's as if the portfolio is whispering a secret that Wall Street isn't talking about. Think about what this means in the real world. The incoming administration has made deregulation a cornerstone of its economic policy, particularly in the energy sector. As drilling restrictions potentially ease and pipeline approvals accelerate, companies like ConocoPhillips and Schlumberger could find themselves operating in a much more favorable business environment. The algorithm doesn't consider politics, it simply follows the numbers. Yet it's positioned the portfolio perfectly to potentially benefit from these policy shifts. But here's where the story gets really interesting. Imagine oil prices climbing back to $80 per barrel or higher, a scenario that's entirely possible with increased global tensions and potential production cuts. Energy companies in SCHD would see their free cash flow surge, potentially leading to significant dividend increases. ConocoPhillips, now the portfolio's largest holding, has already demonstrated its commitment to rewarding shareholders with substantial dividend growth following their windfall profits in 2022. Meanwhile, financials have seen their allocation slashed in half, from 17% down to just 8%. This isn't a small adjustment, it's a seismic shift. Banks and financial institutions that were once cornerstones of the portfolio have been shown the exit. It's as if the algorithm is sensing trouble ahead for financials, perhaps detecting early warning signs in their fundamental metrics that aren't yet obvious to the average investor. The irony here is striking. While many analysts are bullish on banks due to potential deregulation under the new administration, SCHD's algorithm is moving in the opposite direction. It's a reminder that SCHD doesn't make bets on policy outcomes. It focuses solely on the current financial health and dividend sustainability of its components. Consumer staples have also stepped up their presence, now representing 19% of the portfolio, up from 15%. In uncertain economic times, these steady, recession-resistant businesses often provide the stability that dividend investors crave. Companies like General Mills, newly added to the portfolio, offer products that people need regardless of economic conditions. This energy revolution within SCHD isn't just reshuffling which stocks you own. It's fundamentally changing the DNA of the portfolio. It's moving away from interest rate-sensitive financials toward commodity-driven energy companies and consumer staples. The result is a portfolio that's potentially better positioned for inflation, geopolitical uncertainty, and policy shifts that could define the market landscape in 2025 and beyond. But the most pressing question for dividend investors remains: what do these dramatic sector shifts mean for the dividend itself? Will your quarterly payments increase, decrease, or remain stable? That's exactly what we need to investigate next. Dividend impact. Let's talk about what these changes mean for your dividend income. Despite 17 stocks leaving and 20 new ones entering, SCHD's dividend yield remains impressively stable at around 3.8%, which is nearly 3 times higher than the S&P 500's 1.3% yield. The shift toward energy companies could actually boost dividend growth potential. Energy giants like ConocoPhillips have a history of increasing dividends substantially when oil prices are favorable. When oil reached high prices in 2022, ConocoPhillips responded with significant dividend hikes. If oil prices climb to $80 per barrel in 2025, we could see this pattern repeat across multiple energy holdings in the portfolio. At the same time, the reduction in regional bank exposure is likely positive for dividend stability. Banks can be vulnerable to dividend cuts during economic stress, and with their representation cut in half, this risk is significantly reduced. The new additions to the portfolio further strengthen the dividend outlook. Companies like Merck, Target, and General Mills bring long histories of consistent dividend growth. These aren't speculative companies. They're established businesses with predictable, growing income streams. Looking at the complete picture, not only is the current 3.8% yield secure, but the potential for dividend growth may actually be stronger than before. The energy-focused portfolio is well positioned to benefit from rising commodity prices, which could translate directly into higher dividend payments for SCHD investors throughout 2025 and beyond. Now let's examine how these changes might affect SCHD's overall performance compared to the broader market. Performance perspective. SCHD's story isn't just about dividends, it's about total returns. And this is where things get fascinating. Before the tech explosion of 2023 to 2024, SCHD wasn't just keeping pace with the S&P 500, it was actually outperforming it. Let's look at the numbers that most financial media won't tell you. From 2013 through 2022, SCHD delivered a total return of 262% compared to the S&P 500's 223%. That's not just competitive, that's dominance. What happened next? The tech interruption. As the Magnificent Seven tech giants dragged the S&P 500 to new heights, SCHD's diversified approach temporarily lost its edge. But history shows us that no single sector dominates forever. Tech's extraordinary run has created a significant valuation gap that SCHD's objective, numbers-driven approach is now addressing. The beauty of SCHD isn't that it beats the S&P 500 every year. It's that it provides balance and stability when you need it most. Think of it as portfolio insurance. When tech valuations eventually normalize, SCHD's focus on companies with strong fundamentals and growing dividends could once again shine. Looking at the 10-year picture, SCHD has delivered a total return of nearly 200%. That's remarkable consistency for a portfolio that also pays you a substantial dividend along the way. So what's the final verdict on SCHD's 2025 transformation? Is this energy-focused, financial-light portfolio the right move for dividend investors? The evidence points to a resounding yes. The algorithm has positioned SCHD perfectly for the macroeconomic environment we're likely facing. With potential deregulation in the energy sector, companies like ConocoPhillips and Schlumberger could benefit immensely. If inflation remains stubborn, energy stocks have historically served as an effective hedge. The reduction in financial exposure also seems prudent. While many are bullish on banks due to potential deregulation, SCHD's algorithm is detecting something in the numbers that suggests caution is warranted. For income-focused investors, SCHD remains the gold standard of dividend ETFs. It offers the rare combination of a high current yield, consistent dividend growth, and the potential for capital appreciation. The 2025 reconstitution hasn't changed this fundamental value proposition. It's actually strengthened it. If you're heavily invested in technology stocks or the S&P 500, SCHD offers the perfect complement. It zigs when tech zags, providing essential diversification when markets rotate. Personally, I'm most excited about the addition of ConocoPhillips and Merck. ConocoPhillips brings both growth potential and income to the portfolio, while Merck offers stability and consistent dividend increases in the healthcare sector. I'm admittedly disappointed to see BlackRock and Dick's Sporting Goods leave, but that's the nature of SCHD's disciplined approach. No exceptions, no favorites, just the numbers. Now I want to hear from you. What do you think about SCHD's dramatic shift toward energy? Are you concerned about the reduction in financial exposure, or do you see it as a smart move given the current economic landscape? Consider this. If oil prices hit $90 per barrel this year, SCHD could potentially outperform the S&P 500 by a significant margin. But if they remain below $70, we might see a different story unfold. Where do you see energy prices heading, and how might that impact your investment strategy? For those of you holding SCHD and retirement accounts, these changes could significantly impact your income stream over the next decade. Are you comfortable with the new sector allocation, or are you considering complementing SCHD with other dividend ETFs to achieve better diversification? Drop your thoughts in the comments below. I read every single one and would love to hear your perspective on SCHD's evolution. If you found value in this analysis, hit that like button and subscribe for more dividend-focused content delivered straight to your feed. Remember, successful investing isn't about chasing the latest trends. It's about building a portfolio that grows steadily while providing reliable income. And despite the dramatic changes we've seen, SCHD continues to be a cornerstone holding for serious dividend investors. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Investments carry risk and you may lose money.